This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
Hello and welcome to a special summer edition of Wealth and Toil. 5 to 10 minutes on 4 topics for 4 weeks while Dylan and I are off sunning ourselves on the beach somewhere. Well, Dill's probably getting rained on in Hobart, but I'm over in the west having a beer with my family. And so we're going to cover off 4 interesting topics for you guys. Today, we're talking about direct investing in super and how you don't really need to use an SMSF in 2025. DPG, talk to me about why we don't need an SMSF in 2025. This is going to hurt someone's feelings, this 5-minute episode.
Yeah, to all the accountants out there that run a lot of self-managed super funds, I tend
trying to take $3,000 out of your pocket this in your auditing fees this Christmas.
Yeah.
That's my present to you all.
Look, traditionally, when superannuation was in its juvenile stage and we just had sort of large funds with 7 or 8 default options, over time they became more attractive and had more options, but they were very expensive. That is no longer the case. So it hasn't been for probably 10 years now. We've had access to platforms that are called wrap platforms, which effectively is it's a tax structure, runs through superannuation or investment, and you can go and pick and choose any listed assets, any managed funds that are on that approved product list of that provider, and you can go and directly hold units of that in an account in your name. Self-managed super funds used to do that, where people would open them to run their own share trading portfolio's.
They still do.
Yeah, of course, and people still do this.
If you've got one, you probably you'd have to look at whether it's worth paying to continue to run it, or it's worth winding it up or not. But if you're thinking more for the people who are thinking of getting one so they can have some more transparency on their investments, you don't need. The
question is always asked when we look at self-managed super funds. It's like, what you're paying to have a self-managed super fund through your accountant or through someone else is to own those assets directly through your fund and have a personal accountant do your auditing and reporting to ASIC and APRA to effectively make sure that your superannuation fund, your self-managed superannuation fund, meets the requirements of superannuation each year.
It's compliant. You get a non-compliance notice for your super. You don't want that. You want to be.
You don't want that. If, for whatever reason, you only hold cash, term deposits, bonds, shares being the main one, it may be worth getting an understanding of whether or not that self-managed super fund structure is actually worthwhile running, because there is a good chance that you could have an APRA-regulated wrap fund where you can buy exactly the same portfolio and it will be cheaper. And you won't have to do all of the things that you need to do every year with your accountant to do that tax return. We're not trying to rob accountants from their services. A lot of the time, these do work out to be quite cost effective. However, it's just a matter of making sure that you're getting the best deal.
Can I in-specie transfer the assets from my self-managed into a wrap platform?
You can. Yes. So in-specie transfer effectively means that you're not selling from one product to another. So you're not selling down to cash, then moving them across, then rebuying it, costing brokerage, realizing capital gains when you don't necessarily want to. But there is a caveat to that. Not all products allow that. So you need to be sure that whatever product you're moving
you need to know what you're doing is the net.
Know what you're doing.
Yeah. Okay. So that's very good to know. From a Luke perspective, Seneca perspective, all of our investment products, except the Small Companies Fund, are available on both investment and superannuation menus at Premium. So we manage people's money inside super and outside of super for them. We can do a consolidated investment strategy across all your assets, make it tax effective for you, and ensure that you are consistent with your investments across money that's in and outside of super. That is all very normal and sensible stuff that we do. I think I don't have a self-managed super. I just use Seneca superannuation. Very simple. The PDS is on the website. If you want to own direct property inside super, if you want to own things like the Seneca Australian Small Companies Fund or other managed investment schemes that are wholesale only, not on platform, not inside super, not eligible to be inside super, these sort of products are a bit more unique, a bit more bespoke, a bit more different. These are the things that a self-managed super fund is useful for. However, you need to think about the benefit of these products versus the costs at your particular level of wealth. So say, for example, you've got a $10 million fund and you're paying $3,000 a year for admin and $3,000 or $4,000 a year for a tax return. That's about $7,000. If you're on platform, to run that would probably only cost you about $3,000. So, is the extra money worth it? Well, at 10 mil, it probably is. At 2 mil, At maybe 300, not. At 300 grand, almost definitely not. So you don't get a lot of people out there, I think, that I've spoken to over the years, think you need a self-managed super fund to get wealthy, or they get sold down the river by these property charlatan clowns who run around trying to get access to people's superannuation to gear it up to the eyeballs inside self-managed super to buy an investment property in Geraldton or whatever. Please, don't fall for that shit. You're not going to get rich. It's my only tip. My only tip for Christmas.
100%. But also, like, self-managed super funds can be a really good property for certain property.
They can be great. They can be great.
Great example. People that own their own business and have a place of business, buying that asset that you're paying potentially tens or maybe even hundreds of thousands of dollars of rent to someone else as a commercial asset. If you have the capacity to buy that in the self-managed super fund and you know that your business is going to operate there for an extended period of time, that is a wonderful use of your capital. Because that's
asterisk, maybe check general advice. Check it out.
Yeah. But seek advice on it, please, because there is certain circumstances where this works really, really well, and you're effectively then able to put in a business expense as a contribution to paying down an asset owned by your super fund, which you otherwise wouldn't be able to do. But that is something that you need to have a very strong accountant. You need to have a great financial advisor and probably a team of other professionals around you as well. So that's a wrap for
All I wanted to add to that SMSF comment then with the business owners was that's a really good example of when it could work for you. I can give you 50 other examples of when it's probably not a good buying property in self-managed super that probably aren't. So if you fit into that box and you're a business owner looking to buy your own premise, okay, fine. If you're not, I would be very careful.
Very careful. Anyway, seek advice. As always, we'll see you in a week.